Welcome back to Get Paid for Your Pad. My guest today is Mr. Derrick Barker. He's been on the podcast a couple of times, I think. He's one of the founders of Nectar, which is well, I'll let you explain what Nectar is. Derrick, welcome to the show.
Thanks, Jasper. Great to be back. Great to be back on the show. It's been, I don't know, it's like a year and a half maybe since I was last on, and lots happened. So thanks for having me back.
Yeah, 100%, man. 100%. I can't believe we connected shortly before we had that mastermind in Mexico, right? In Oaxaca.
Which is probably one of the best masterminds I've ever been to. Not one of, it's like top two best masterminds across anything, any industry. And for listeners, my background, so I was in finance, I played football, I did a lot of stuff, a lot of different masterminds. These guys, y'all was the best.
I love hearing that. And I'm not paying Derrick to say that, by the way, just so you know.
Oh no. But
awesome,
but
man.
yeah.
Well, give us a quick update, dude. Tell us for the people that don't know what Nectar is, like, give us a quick intro and tell us what's going on in the last year and a half. Things have changed a little bit when it comes to interest rates and stuff. So we have a lot of interesting stuff to talk about.
Yeah. So I'd love to do that. I'll start with like a quick background on me, and then like a little bit about what Nectar does, and then love to talk about interest rates because that's what everybody's thinking about. At least everybody in my world. So my background is I'm an entrepreneur. I started my first business when I was a freshman at Harvard University. It ended up doing really well, and I started buying real estate. So I bought, built, rehabbed, asset managed, property managed over $450 million in assets, mostly in the multifamily space. So over 4,500 units of apartments. But also had a short-term rental portfolio. So I had 125 short-term rentals that my partner, Brittany, who's also my wife and also the co-founder of Nectar, she built and ran that portfolio. And so that's my background. I'm an entrepreneur and real estate guy. I had one real job where I traded bonds at Goldman Sachs. So I was a bond trader too, but that was a past life, but it was also really interesting and fun. I started Nectar a couple years ago. Really and we provide basically working capital loans to professional real estate owners and operators. We started out in the short-term rental space primarily, because we're looking at people's cash flow, net cash flow, and we'll lend against that. So we're not a mortgage. We'll work with your mortgage. So if you have a mortgage already and you have a stabilized cash flowing asset, that's like, it's low leverage. So if you're 90% leverage, there's nothing we can do with, but if you have like a stable assets, we can provide a working capital loan that you can use for any purposes, similar to a cash out refi. So people have used our funds to buy management companies or to do renovations, put in pools or hot tubs or buy additional properties or just finish rehabs. It's super flexible. Buy a boat. One guy bought a boat. So that's what we are. We're flexible capital for people with low leverage cash flowing assets.
Tell me about the guy who bought a boat. That's interesting.
Yeah. So, I mean, he was on some lake. Is it Lake Placid? Maybe. Had some properties, bunch of properties in the lake, and he wanted to have a boat to rent out to them. So he wasn't buying a boat to just chill.
I was going to say, I imagine you're not going to lend. I want a boat. Can you give me some cash? I'll buy a boat right now.
Yeah, it was an income generating boat.
Okay. Cool, dude. And we talked about a year and a half ago. The lending climate I feel like has completely changed. I mean, you know a lot more about this stuff than I do. I just see the interest rates, and they've been going up. I think they're at the highest since early 2000s, maybe. Right? What's does that mean does that mean it's just way more expensive now to borrow money, essentially?
Yes. But it means more than just that. We live in a world where asset prices are valued based off of discounted cash flows. What does that mean? That means that when you look at the value of a property, people use, in the real estate space, cap rates. all a cap rate is a rate that you discount future cash flows. That's why I used to, you're in the higher, like, and when interest rates are, and that's how all assets are valued. Stocks, bonds, startups, oil fields, like that's just the world that we live in. When interest rates are higher, the value of future cash flows go down mathematically. So interest rates make it harder to lend, but it also means that asset prices mathematically have to go down. And if we look at what's happened in the past recessions over history, just going back into the 1800s, typically what happens is there's some kind of, you can call it a bubble or run up. There are good times. Then there's some amount of worry about inflation, and the Fed raises interest rates. They raise interest rates because to tame inflation. And the first thing that happens is lending gets more expensive for banks. Then when lending is more expensive for banks, they pass that on to their customers by making loans more expensive. And then for customers that are operating the economy's regular businesses, they have less access to capital. You have less access to capital, you're less likely to pay people those higher wages or invest in that new thing. And then that investment or that spending, that's someone's income. So incomes go down. It takes a long time for that whole process. And then when incomes go down, people spend less, which makes incomes go down more, which means that asset prices go down. But it takes a long time for that to all play out. On average, from the time the Fed stops raising interest rates to the time a recession starts is typically 10 months. 10 on average, going back to looking at the last recessions, because it just takes a long time. We have a big economy with a lot of people doing a lot of things. It takes a long, like the Fed doesn't directly impact things; it's indirect, and so that's where we are right now. The Fed has stopped raising interest rates in July, was it? 10 months is May. We're not there yet, so we're in this period where you can see, banks have pulled back, lending is more expensive. A lot of lenders, even though they're not even focused on lending, they're even if they do have money available and they can loan at higher rates, they're just not doing it. They're lower leverage because they think asset prices are going down, rightfully so. So credit's not as available. It's harder to get money. Money is harder to come by. So that's where
you step in.
That's where we step in. So like it's a great environment to be a non-bank lender, for many reasons. And specifically, you have people, you got a 3% mortgage on that property that you got 4 years ago, and you have a ton of equity in that property because the past 4 years have been good, and you need liquidity. Well, you don't want to refi out of that 3% rate, Right. And that's where we come in. We'll give you the liquidity you need without having to give up your mortgage, without having to get up that low rate, or without having to go to a bank who doesn't want to lend. Like banks don't want to lend right now anyway. So.
Yeah, I have a bank account I just recently moved to the States, so they don't know me for that long, and I'm a foreigner and everything, and I just for fun I asked them like. Because for Free Wild, like we just finished our renovations. We're planning to build more units, and we have private investors. But just for fun, I was wondering, like, what if we didn't have like private investors and we had to loan money from the bank, right? So I just told my banker, I was like, hey, this is what we're doing, this is what we're planning. Like, how much, what would the process be like if we want to get like a construction loan or something? And he asked me a couple questions, and he was like, yeah, it's going to be difficult, man. Like, right now that's like, it's very, very difficult to get these loans. Like your company has to be established and, showing profit for like multiple years. Like we really got to know you. Like the bank is not willing to take much risk right now. So I was like, okay, well, that's good to know.
Yeah. And multiply that times every single capital allocator in the country, but in equity too, like debt and equity. It's just like cash is hard. It's like liquidity is hard to come by now. And that's not something that like people, I go and talk to people like, oh, well, we're just going to hold off for now until rates go back down. I don't think that that's happening in the near term, but it might happen. But just let's talk about the Fed a little bit. And do you mind if I get a little nerdy and go down to, rabbit hole in
Totally.
this.
I'm with you. I'm right with you there in Nerdland. So
All right. So the Fed is an institution, like any institution, and they have their heroes and they have their villains. Inflation's one villain, but their hero is Paul Volcker. He tamed inflation in the 70s by keeping interest rates high and holding it high, even when there was stagflation and there's political pressure and there was, all the things that happened. He said, nope, I'm keeping interest rate high. And he ended up beating inflation. Inflation came down, and you've had a after that 30-year bull run in rates, the 30 years of low inflation. Um, the guy before him faced the economy that, there was inflation, and he raised rates. And then the economy came into recession and inflation went down a little bit. And then he cut rates quickly. I'm forgetting his name. I don't know why I'm forgetting his name, but we can look it up. The guy before Paul Volcker. And then when he cut rates, inflation came back. And he is the villain of the Fed. Like, everybody remembers that. If you work in the Fed, you remember both those two guys. Hero, villain. What Jerome Powell is not going to do is he's not going to be a villain who, like, it's already happened in the 70s where there was inflation, they raised rates, then they cut rates too early, and inflation came back. Like, he's not going to do that. Like, no one at the Fed wants to do that. They look like they're paying attention. Like, they're an institution that has a culture, and their culture is, we're not doing that. So they're not going to cut rates until people are begging, until the economy is crashing and stocks are down 40%. And, there's political pressure, and there's, economic pressure, and there are people protesting saying, hey, the Fed is terrible. And then the world is falling apart. And then Jay Powell will say, okay, I guess things are bad enough for our lower rates. That's what we need to see happen in order to see rates going back down. That's what I believe. Now, people disagree, and people out there can disagree. No, I'm just going to hold out. I don't think that holding out is going to be something that makes sense if you're waiting for rates to go down. But I do think because of that history, because of that perspective at the Fed, like, we're going to hold rates higher and we're going to see pain. He says it. Just listen to the word he says. There will be pain in the economy. He's not kidding. That's what he wants to see, to lower rates. Because of that, they're going to be buying opportunities. But the buying opportunities are going to come when people are when the headlines are scary headlines, and the stock market is a scary place, and things are going down, and nobody wants to buy because everybody's scared. That's when the opportunities are going to come. So if you're holding out, I'd hold out for that.
Got it. Okay, got two questions for you. Number one is, so Paul Volcker in the 70s raised the interest rates, I think, all the way up to like almost 20%. Isn't that right?
Something like that, yeah.
And I hear you saying that the Fed has now stopped. Did they really stop, or did they just kind of pause?
I know that they are going to do what they think is best, and that I don't know. I know for a fact that I don't know.
Wait, are you telling me you can't predict the future?
I think it was Will Miller. Oh, sorry.
Oh, I was going to say, are you telling me you can't predict the future?
I'm telling you that, yeah, my future prediction capabilities are not great. Past, and I can tell you what happened then. And even though times change, human beings don't change that much. Like, human nature stays the same, and that's why we have economic cycles, because people are still the same people they were 1,000 years ago. Same human nature. Yeah, it's just different clothes.
So basically, what's happening is, we have these higher interest rates. It's harder to borrow money, right? But at the same time, like, 70% of mortgages are like below 4% or something like that. So no one wants to sell the house, because then they're gonna lose their mortgage, essentially, right? So are we seeing like just a kind of a slowdown in like sales in the real estate market? Is that what's happening?
That's what's happening. That's what's happening now. Like, single family sales and multifamily across the board in real estate, transaction volume is cratered. It's down. Because the people who don't have to sell, they know it's not a great time to sell. And people don't have to buy, and they're putting their pro forma, and they want prices to be lower. Volumes have gone down. And in the single family market, I don't feel convicted that the prices are going to go down a lot, because you have this lock-in effect where they're 30-year mortgages, and most mortgages are long-term, so people don't have to sell. You have developers, but that's not that much supply. The multifamily space, though, Other places in commercial real estate, there's just shorter term debt, and there's a lot more supply. There's a lot of things that are currently being built that are going to deliver, and they're going to price. And they're gonna and those developers, once they finish building, they don't want to hold these assets. They have short-term construction loans, and they're going to sell. They're going to find where the market is. They're going to sell, and that's going to change prices. That's going to change rents. It's going to impact the market. Single family is not clear. I don't know. I can't predict the future, but you have this 30-year lock-in effect that might.
Right.
Yeah.
So you're saying for the multifamily, like the developers, basically they finish their project, they got to sell, they got to sell these units, but because the interest rate is so high now, like people can't afford very high prices, right? Because like if the interest rate is like, let's say 3% versus 6%, well that means it's only a difference of 3%, but that means your monthly payment doubles. Right. So like people can't afford to pay a lot for these things. So they're going to sell them at lower prices. So I guess there's a buying opportunity potentially, right?
Potentially. Yeah.
If you have cash, right? If you don't have to borrow.
Yeah. And these developers who are building these properties, I mean, for all my people out there doing like, fix and flips and developing properties, how often do your projects go over budget? Like it's a common thing. And once you get finished and you have an over budget project that you've had to fund, you haven't made any income in a while, and you have a loan coming due, there's a lot of pressure to sell and get that cash back in your pocket. And if the market is not the perfect time, like there are going to be some people that are like, I'm just gonna hold, I'm gonna refi, I just have to. But there are a lot of people who they don't have the liquidity. Even big developers and small developers and medium-sized developers, they're all playing the same game. Or similar games. They're playing the same. They're going to have the same factors. It's going to cause supply. Supply is going to hit the market. It's going to push prices down. It's just going to happen. Again, single family is hard to know. You have so much of the stock of housing that's just locked in to 30-year mortgages. Developers, they still, people develop single family properties too. But I don't know. It's harder. It's harder to tell. It's harder to see like a straight forcing function.
Yeah. So you're saying, you're saying the Fed has just stopped raising the interest rates now, and you're saying like typically, like obviously we can't predict the future, but typically it takes about 10 months for that to work through the economy and for the effects to be visible in terms of like some people might lose their jobs and like consumer spending goes down and everything, and then we're talking, I think officially talk about recession when there's 2 consecutive quarters of negative GDP growth. Is that right?
Mm-hmm. Yep.
So then like is it would the Federal Reserve, because they also worry about the economy, right? Like you think they might just bring interest rates back down a little bit if unemployment starts to rise?
The Fed has what they call a dual mandate, but there's one reason the Fed exists, and that is inflation. Like that is their primary goal, and they say it, and it's like I don't know. Again, it's an institution with customs and norms, and their big thing is inflation. Inflation is the boogeyman. That's the thing that they wake up at night and are worried about, and they're worried less about. And like they know in their mind, the way that you stop inflation is getting people fired so that they don't have the money to spend on goods. Like that is how it works. They do the things that it takes to bring unemployment higher. And when there's higher unemployment, then people don't have money because they don't have jobs. And people don't have money because they don't have jobs. They spend less money because they don't have a job. That's the way it works. How do they get people to lose their jobs? They raise interest rates. And eventually raising interest rates turns into job loss. Like that is the way that are they worried about a recession? Like they're specifically doing this to cause a recession. And they're specifically doing this to cause unemployment to go up. That's the game. That's what they're trying to do. Are they worried about it? They're worried about it getting too bad, but they want it to happen.
Right. I imagine like this, being the president of the Fed, like especially in a situation like this, might not be the most popular person in the world if your goal is to cause a recession.
No, Paul Volcker wasn't either, but he's their hero. Like, he was not a
Right.
popular person, but but he is
Right.
he's their hero. He became popular later on,
Right.
but it took a
Yeah,
long
like
time.
looking back, because when you're in the heat of the moment, like I'm sure, like everybody, that if you lose your job or something, you're gonna look at that fat guy and be like, "What the hell," But then, like looking back 10 years later, you see like, oh, okay, well, if inflation would have gotten out of control, that probably like more people would have lost their jobs, right? I mean, look at what happened in Germany in the 1920s, and then look at countries like Zimbabwe, Argentina. I mean, there's a lot of examples where that actually happens, where they didn't raise those rates because they're like, oh well, we don't want to cause a recession, so let's whatever, let the inflation just be, let it be, and then before you know it, it gets out of control, and then that's even worse for the country, right?
So Zimbabwe, I mean, some of these countries they're very different. Like, they're very different because they ultimately they're we there was a world war. We won it because we had an atom bomb where we're saying, hey, we'll just blow up your whole city if you mess with us. And so we won that world war, right? That's what happened. We destroyed the economic base of like the rest of the developed world through the war, right? The war was over in Europe. We had oceans between us. They only attacked us once in Hawaii because it takes a long time to get from where the war was, which is Asia and Europe, to here. So we had an economy, and everyone else was blown up. So that happened. Because of that, the world uses our money. The world still uses
Mm.
our money. If you want to buy some oil, you use a dollar. If you want to buy so because of that, you can't really compare us to these other places. However, we can still screw it up, and we're doing our best to screw it up. You can still do it, and you do that by, having $2 trillion deficits, by having instability, but the fundamentals are you have more demand you have more dollars chasing not enough goods. So consistently underinvesting in productivity for a generation, and consistently creating more dollars than you're creating like actual goods and services. That's how you get inflation, and we've done it. That's what we've done. We've consistently underinvested in you know I don't know, in our capacity to produce. We're trying to reverse some of that. We have these huge deficits. Our tax receipts are going down. We've cut taxes, so our tax receipts are going down. Our economy is growing, that's helping. So yeah, we have the conditions for recession, but it's not going to be Zimbabwe just because we don't have
Mm.
because we have the economy is based on our dollar because
Right.
because of the historical events that have happened. But we can still
Well, that's
have
interesting you mentioned that. I lived in Panama for 2 years, and I remember when I first moved to Panama, like I was like, I go to the cash machine at the airport, and it's like dollars, and I'm like, wait, where can I get like the local currency? And then turns out that was the local currency. So
yeah.
they're basically using dollars. It's funny, like the country just says like, hey, let's lose another country's money. It was funny because I was thinking like, where did it get all these dollars in the first place? Like, they just like go to the Fed and said like, hey, can you guys give us give us a bunch of dollars so that we could use dollars as our currency, so we don't have to make our own.
Yeah. I mean, or if you need American assets and you need to bring dollars in order to spend them on those American assets. And America is still a great place to invest. It's safe. Our economy grows. That's why people want dollars to invest in dollar assets. And I don't know that's still the case even to this day. And I don't think that's not going to change in this cycle.
Right.
What can happen is our economy can still go down. Asset prices can still go down. Even if we don't have Zimbabwe like inflation, we can have asset prices going down. Um,
Right.
Raising rates is the opposite. It literally is the opposite of inflation, right? Inflation is the dollars being worth less. If you raise interest rates, then you get paid more to own dollars. You get paid more to own treasuries, right? You used to get paid
Yeah.
nothing. Now you get paid 5%. So it's like making it more valuable to have dollars because you have a dollar, you can buy a treasury. So for that, like the dollar value should go up. But asset prices should go down. The asset price, if dollars go up, the assets that you um, buy with those dollars go down relatively.
Hmm. Also,
Uh,
like I noticed that the third quarter, the US GDP grew at 4.9%, which is pretty. That's
Crazy,
a solid number, right? So it's kind of
crazy
interesting.
number.
When you look at that number, you think, wow, that's very solid growth. Like what are we talking about? Recessions, 5% like GDP growth.
Yeah, it's great.
That's a
It's
lot.
great. To be honest, you know what? I hope like it. Firstly, yeah, that's just a lot. It's just nothing other than that's a lot. Our economy is resilient. You know, it's a resilient economy. We still have like a pretty strong economy. No matter people try to beat up on the U.S., we still have a strong economy. We have a lot of people doing a lot of cool things and it's growing. Um, you know, and maybe the recession isn't going to be that bad, but asset prices are going to like go down just because you got to make the math work. When
Hmm.
you're going to buy a deal and you underwrite the deal with this, and it's the same numbers as last year, except for the interest rate is twice as high, something has to give. It's going to be prices.
Yeah. You know what? Like, let me share my screen real quick here. I'm gonna show you this because I'm looking at the graph of the US GDP growth over the last few years. You see that? You see this graph over here?
Ah, okay.
Can you see it?
Yeah, yeah,
So
yeah.
for those who are listening and we're not watching on YouTube, let me explain what we're looking at. So we're actually looking at the U.S. real gross domestic product, the percentage change from starting in 2021 all the way down to the third quarter of 2023. And what we're looking at is that the GDP growth was very solid in 2021. It was like 5, 6, 3.3, 7% even. Then we had 2 quarters of negative economic growth. So technically that was a recession, I guess, Q1 of 2022. And then the second quarter of 2022, we had a small negative GDP growth. And then we kind of hovered around like the 2 to 2.5%. And now suddenly it's like 4.9. So when I look at this, I feel like, oh, we already had the recession. Now we're out of it. That's what it looks like,
Yeah.
right?
That's what it looks like. I don't know, but what you had in Q2 2022, or no, sorry, what you had at the beginning of this year is you had like banks failing, right? When a bank fails, like the people that they would lend to in the future are now not getting loans, and it takes time for those people who would have gotten loans from these banks that failed to not get the loans, and then it takes time for them to like not have the money and for it to uh, um, result in them not hiring, and that not hiring to result in less income, that less income to result in layoffs. It just takes time. I don't know, like in like that Q1, Q2, like that at that point, the Fed hadn't stopped raising. The Fed was continuing to raise. So
Mm-hmm.
like maybe if you would go back, I don't have this chart, but if you can go back and show the chart of like Fed, like Fed funds rate and GDP growth, first it goes up and then there's a recession later. Is not that there's a recession and then it goes up and then things are fine. That chart that you showed is like there is maybe a little recession, but the rate kept going up. And like when the rate keeps like, I don't know, I have not seen it happen where the Fed funds rate goes up, it stops, and then everything keeps going up, and then like it goes back down. Maybe it will happen this time, though. It might happen this time. I hope so. It makes my life a little bit easier. But maybe in the short term, but in the long term, we want recessions. It's good for the long term viability. It washes out some of the, some of the businesses that some of the excesses, and then it resets asset prices at a level where people can buy. And for like
Mm-hmm.
a lot of people in the short term rental space are youngish. Like I call myself young. I'm still young, right? 30s counts. And we haven't had a chance to go and really get the good deals that are around when there are recessions, when asset prices reset. And yeah, we're getting our shot. So just be ready, like you see it. So just like prepare yourself, have liquidity, like just have
Mm-hmm.
liquidity. And if things are bad, then you'll have the liquidity to take advantage, to make it through and to take advantage of the upswing. And if things aren't
Mm-hmm.
bad, then then you'll still have liquidity, and then you'll look around and be like, oh well, it's December 2024. There was no recession, and then you can like invest at that time, and and things will be fine. Um, so I don't
All
know.
right. Well, when I have to schedule a podcast with you in December 2024 and see if your predictions came true.
Let's do it. Let's do it.
All
But
right.
we
Well,
at
listen.
Nectar, even though like Nectar specifically, circle back, we started this business to give people with low leverage cash flowing assets access to liquidity in any environment. Like like what I believe is that in no matter what happens, if the economy is good or the economy is bad, you have people that are prudent and you have people that are reaching and that are doing things that are not prudent. The people who win out in recessions are people who are prudent before the recession. The people who have low leverage make it. The people who have high leverage don't. That's the way it works. The people who have liquidity make it. The people who have assets that are cash flowing and that are stabilized, they make it because they don't need to sell. They can just sit around. It's like, oh, I'll just sit on my cash flow. Maybe my cash flow is a little bit less, but you're going to make it and they're going to be around. And what Nectar is here to do, we've created Nectar to give people who have low leverage cash flowing assets the liquidity they need to do whatever it is they need to do in any environment, because those are going to be the people who make it. And they're going to be the people that dominate when we come out of the recession. The good thing about recessions is you come out of them and then there's long runway to take less risk and have big upside. The people who have low leverage, the people who have liquidity, the people who have assets that are cash flowing, they're going to be in the best position to take advantage of the mishaps that happen in a recession. I'm super excited because we've been able to find a lot of these people, and I'm even more excited, to continue to lend through this environment and help people dominate and come out of this stronger than ever with assets that they got. And get deals and, that they underwrite prudently, because it was they were tougher times. So,
and buy boats.
Yeah. And short-term rentals are going to be like, maybe, there might be a short-term rental recession. Maybe if consumer spending is down and people getting fired from their jobs, there's going to be, but afterwards, if you think that there's like revenge travel after the, COVID, there's going to be revenge travel, once the recession's over and people are back in their jobs and people are like, and they don't have this overhang. And the people who are prepared and still own their assets and have low leverage, they're going to benefit.
But also, like if incomes come down a little bit and we do get a slowdown in the economy, right? It doesn't, that not necessarily a threat to demand in every market, because like imagine like, we're close to like LA and San Diego, and I'm thinking like, if I have a lot of cash, I might go to the Maldives or something, for 2 weeks. Like, my wife would like that, to sit in a romantic, little cabin on the ocean, watch the sharks and stuff like that. But if like things are a little tight, I might just go to Idlewild, 2-hour drive, So yeah, it's not necessarily gonna bad for every market, because that was what we saw during COVID, right? Like everyone's freaking out during COVID, like, oh, the whole, it's the big bust, and like everyone's gonna lose their business and everything. And a couple months later, like people are like, oh, damn, like we've never seen this high demand because people stop flying, so now they drive up and stay close to home.
Yeah, I mean, COVID was just a very specific thing that this is not going to be. In COVID, there was a pandemic, so like people couldn't, weren't traveling, weren't flying, they were staying in, they weren't at work, and the government stimulated the economy in a historic way. The government is doing the exact opposite. They're taking stimulus out of the economy. So yeah, everything's not going to be doom and gloom, but the aggregate demand is going to go down. Aggregate demand. So that means that even if, there are going to be some people that would go to the Maldives, now they're going to go to Free Wild. There's some people who would go to Free Wild, now they're going to the Best Western. And there are people that would go to the Best Western that are going to be staying at home job hunting. And I don't know, that was kind of trite. So I didn't mean to be offensive in any way. But that's the aggregate. If the unemployment rate goes from 3% to 5%, then that's 2% of people who are going to take a vacation, who are maybe 3% of people. So it's not going to be huge, but it's just that 3% means you're probably not growing, and the people who are the weakest hands are going to be hurt the worst. The people who underwrote, oh, I have to get this 3% rent growth every month or every year, or else I'm not going to be able to cover my refinance my mortgage. They're going to be hurt. And the people who have some capacity and have some slack and have low leverage, they're going to be like, oh, okay, well, it's not that bad. It's a 3% instead of rents going up 3%, ADRs went down 3%. Okay, I'm fine. That's how some people is going to be that.
Right. So let's talk a little bit more about Nectar and like your process. So if somebody's listening now and thinking, okay, you know what? I just did some market research and I decided that investing in a hot tub is going to raise my ADR by so much that I'll make my investment back in a year, right? Which is actually probably a pretty good idea. But yeah, so like, okay, I want to invest like 15K in the hot tub, right? I don't have that cash lying around. So I call Derrick and I'm like, Derrick, I want to, buy the hot tub. Well, like what do I do? What are the next steps?
So we're not looking at your hot tub investment and what it does to ADRs. Like that's not a part of our process in any way. We're looking at we want to see your portfolio. We're looking at an entity. So if you have every property in the different entities, we can look at it entity by entity. If you have one entity with a ton of properties, we're looking at all the properties in that entity. So we attach at the entity level. But we're looking at what are the actual cash flows that you have made in the past 12 months. What are the actual numbers of your net income after debt service? That's what we're looking at. And we'll say, okay, we'll take that. We'll say, okay, well, we'll do a stress test. What happens if you're down 15%? What does that look like to make sure that you could have the margin to survive whatever might come? And then we lend against that. And so if you can still pay us back, even like not based off of any projections, but based off of what you're currently doing, then we'll lend. And our typical deal size is probably 250,000 or 300,000. So typically we're looking at bigger properties or multiple properties, portfolios of properties, or like multifamily. So we'll do smaller deals, $50,000 or the like. So a few hot tubs, and that's yeah. And you give us your P&L,
or a really fancy one,
yeah. So we'll look at the net cash flow. We'll look at your loan docs, all your debt. We'll want to see all your debt and all those docs. We'll connect to your bank account. Really, we just we connect to your bank account to make sure that it matches your P&L and that you pay your bills. You'd be surprised. We got a lot of people who's like they're borrowing from us. It's like, but you have like 70 NSFs. Like you're not paying your bills. We're not going to lend to you. And that's it. We're just trying to see, are you making cash flow? What does your current debt picture look like? Are you over levered, and do you pay your bills? And if the answer is yes to those things, then we'll lend, and you can do whatever you want with the money.
Got it. And then how do we pay back?
Over time. So typically we do 1 to 5 year terms, and it's just monthly payments out of cash flow. So it's no balloon pay. Typically there are no balloon payments at the end, although we can structure it so that there's a balloon payment in certain cases. But there's you have equal monthly payments for 1 to 5 years, depending on kind of what you want to do, and that's it. Then we go away, and that's it. That's how it works.
Awesome, dude. Anything you want to discuss that we haven't talked about yet? Because we've been talking for 40 minutes. Like time flies.
Yeah. I don't know. I think we got a bunch of things. I got to talk about my favorite thing, which is interest rate. And sorry if I'm kind of bearish here, but no, there are people out there. I guess the last thing is like realistic. And look, in these environments is when the people who have been prudent, the people who have strong businesses, who have invested in their operations, who've invested in having in their capital stack and having low leverage and high cash flow, and have just done things the right way. This is your time to shine. Like for a long time, it's just whoever can get the flashiest thing, whoever can just be buying the most stuff, and and who's just scaling fastest. That's the economy has benefited people who are just moving fast and growing fast. You can do that, but now the emphasis is going to go away from that and the core of what the fundamentals of your business. Do you have strong operations? Do you have a strong brand that stands out in the market? Do you have a strong property that stands out in the market that people love? Do you have strong financial operations? Are you low leverage? Those are the people who are going to stand out and be able to take advantage of this environment. We're looking for those people, and we want to be a capital partner to those people to provide liquidity to dominate. And now is the time. Now's the time to dominate.
Now is the time to dominate. I like that. Let's wrap it up with that. And for the people who are interested in working with Nectar, people are interested in finding out how to get a loan from you guys. Like, what's the best step?
Best step is to reach out to us. Jasper will drop a link in the show notes or wherever the notes are. One is I don't know, what was use nectar.com/overnight success. And then, sorry, I don't know
I'll create a link for people. I'll create a link for people. I know how to do that. We can just have a link, getpaidforyourpad.com/nectar.
Yes.
And then that will redirect to the best place. And then, obviously you're going to have to give people from Get Paid for Your Pad, you have to give them a VIP treatment.
Oh yeah, VIP treatment. Anyone who comes through Get Paid for Your Pad. So we typically have like a wait list of like people who are like looking for funds. Sometimes we get backed up. Usually we can process through very quickly, but sometimes we get backed up. Anyone who comes through Get Paid for Your Pad, we'll put at the front of the line. So it's VIP treatment. There's a line around the corner. The bouncers will see the Get Paid for Your Pad, and they will let you to the front of the line. We'll get back to you immediately. Our underwriters will put your files first. Both in the beginning for the quote phase and then all the way through until you get the dollars in your account.
Boom. That's what I like to hear. And it's pretty fast anyway, because, typical turnaround is like 7. I'm just seeing on your website, right? But I know from the people that I know that worked with you, like a bunch of our people in our mastermind and Legends X have worked with you. So I know it's a fast turnaround anyway. But yeah, we'll just go to getpaidforyourpad.com/nectar. And then so it's NECTAR, and then you'll be directed to the right page where Derrick is going to treat you like a king or queen.
Yes, exactly, and we'll give you our best rates. So we have rates that are tiered. I can't tell you what those rates are because it depends on what your portfolio looks like. But we'll give you the Get Paid for Your Pad boost to take you to that next tier.
Boom. Love it. All right, Derrick, always a pleasure to talk with you. I'm going to sit in the corner and cry a little bit because I'm worried about the recession now, but,
Yeah, cry a little
just
bit.
Kidding.
But then just get like 10 months. We have some time. Get ready, weather through it, and then we'll have the best money-making opportunities of our generation.
That's right. There's more millionaires are made during recessions and then in the good times, actually, because what you mentioned is like there's opportunities, right? There's opportunities that will come. So be ready, and everything will be fine.
Yep.
Everything will be fine. Don't worry about it. Okay, cool.
Everything will be fine. Just
Derrick,
stay alive, keep kicking, and then even if you have bad things happen, that's fine. There are plenty. One of my investors lost a ton of money in the recession happened in 87 or 88. I don't remember. I was busy being born. But and then he said he lost everything. And you know what? He built a portfolio that was way bigger and way better, right? Because there's opportunity after recession. Right. Keep living, keep working. It's a grind.
All right. Let's do it. Thanks, Derrick. I appreciate you jumping on here. And for the listeners, hope you enjoyed this episode. Hope you're not feeling depressed right now. And, make sure the next episode is going to be like a very positive one, just to balance it out.
All right, man. Thanks for having me on, Jasper.
All right. Thanks for listening, everybody. We'll be back next time. Have a great week or weekend, and we'll see you soon.